Hello, my name is Shruti, and it's a pleasure to welcome you to our market podcast, where we will be presenting our weekly tanker market for past week, that is week 45. On behalf of Saigal Seatrade, I would like to extend a very warm welcome to all our participants and audience. For those who are new to Saigal Seatrade, we are one of the largest and most prominent shipbrokers and maritime consultants in India. Our team includes over 100 dedicated professionals specializing in dry bulk and tanker markets. With offices in Delhi, Mumbai, and Ahmedabad, we are readily available to support our clients not only through our regional presence but also through phone, email, and social media. In addition, we have a dedicated research department that regularly collaborates with Indian stakeholders across shipping and commodity sectors. Our team provides in depth, timely market insights through weekly and monthly reports available to anyone interested. Simply reach out to us. Today we have Sandesh Ghandat and Trisha Mohite with us, and today we are diving deep into the tanker market, an essential part of the shipping industry that keeps the global economy moving by transporting crude oil, LNG, and other critical resources. We'll all have a detailed look at key sectors of the tanker market that include crude, clean petroleum products, also known as CPP, LPG, LNG, and chemicals. Now, to begin with, let's understand crude tanker market briefly. In the crude tanker market, we have seen some mixed movements across key routes this past week. Freight rates for VLCCs on routes from the Middle East Gulf to Asia dipped slightly, with rates to Singapore and China ending at world scale 50.35 and 49.25, which was roughly down by 6.7% from the previous week. Now, this drop comes from softer winter demand and plenty of available vessels. West Africa to China routes also softened, settling at world scale 52.11. And the US Gulf to China route saw a $21 million lump sum decline, closing at $7.54 million lump sum. These reductions largely reflect weak sentiment and reduced Chinese demand. Aframax rates from Kuwait to Singapore also fell to world scale 155, marking a 6% decrease. Having said that, Sandesh, I would like to know your perspective on global crude tanker market fundamentals last week.
Shruti, thanks for the introduction. Last week, crude tanker market remained soft across all the segments. That includes all the type of crude vessels, VLCC, Suezmax, and Aframax. And freight rates were also under pressure due to limited demand and ample vessel availability. Now, when we talk about VLCC out of Middle East, Gulf, and West Africa, that means those VLCCs are going to load crude oil cargo from Middle East, Gulf, and West Africa. The rates were flat, and those are impacted by due to low Chinese demand. And since we are talking about winter, the winter cargoes were also subdued. Now, talking about Suezmax and Aframax, they face the similar challenges with very few inquiries and falling rates across major routes. A slight boost in activity may come post Bahari event, which is what we are expecting, but the fundamentals suggest a weak or stable outlook. So, overall, the market awaits clearer demand signals to drive any meaningful recovery. So let's dive into the crude market where we talk about the specifics. As of right now, things are were looking a bit flat across the board with rates in the most segments under pressure and demand just not picking up as many were hoped for. Now, starting with VLCCs, the vessels out of Middle East Gulf, the market was pretty quiet. Everyone was waiting to see if any policy changes come up after the US election. So which has supposed to keep things in a bit of holding pattern. It was expected like that, and unlike other years, winter demand hasn't really kicked in yet. So there is a lot of competition for the same cargoes, and rates stayed flat because of that competition. And while we saw little improvement at the end of last week, it's hard to get too optimistic. When we talk about the demand, we should focus on China. So Chinese demand has been low, and without that, a big uptick doesn't look like anytime soon. So this is about Middle East Gulf. Now moving on to the West Africa, the story was pretty much the same. The VLCC market here also oversupplied with tonnage and with the reduced cargo demand, and rates were slipping. So normally we would see a boost from the winter cargoes by now, but that hasn't materialized. So owners are having a tough time. They were having a tough time last week, and we expect that situation may change in coming weeks. As far as U.S. Gulf Coast concerned, VLCC rates kept falling last week because there just aren't many few inquiries. The recent Hurricane Rafael that happened in last week, it did shut down some oil production in the Gulf of Mexico, and it's supposed to provide some short-term support for prices, but the impact is expected to be pretty temporary. Now coming on to the Suezmax segment, it's been quite market here too, but especially out of MEG. The cargoes were limited and charterers were being able to negotiate lower rates since there is plenty of vessel availability. There might be a small boost in activity after the Bahari event wraps up, but overall the fundamentals suggest that rates will probably stay where they are for now. And in WAV, Suezmax rates are also down due to extensive list of available vessels. And having said that, few cargoes were there, but nothing materialized. Charterers were holding back on fixing, and that has made one of the slowest weeks we have seen recently. For the Aframaxes, we are seeing subdued activity both in the Middle East, Gulf, and Southeast Asia. In the MEG, the benchmarks Kuwait Singapore freight were also declined with rates remain under pressure. Now, unless fresh batch of cargoes, this downtrend is likely to continue by at least next 2 weeks. That's what we are expecting. Uh, the Southeast Asia market, which was also experienced a similar trend, was also no major activity witnessed. Now, the benchmark Southeast Asia Australia route, the freights were also down, and they were declined last week with the reduced cargo. There was enough tonnage to cover existing demand, so unless we see more inquiries, the market softness will probably carry over into the next week.
Yeah, all right, all right. So, what do you think will be the big picture for the upcoming week?
So post Bahari event, things should pick up, but several factors are holding back the crude market right now. And uncertainty after the US election, OPEC's recent delay on their planned production increase, and that of the usual winter demand are all keeping things restrained. There is a bit of a wait and see approach present, uh, but especially as the charterers are cautious about committing when the market doesn't show much momentum. And while Hurricane Rafael in the Gulf of Mexico did disrupt some production, the support from that is expected to be short-lived. Now, to sum up, overall rates across VLCC, Suezmax, and Aframax were under pressure, and while we might see a small bounce post-Bari week or as the year-end approaches, current fundamentals suggest a soft or at best a neutral outlook. So everyone is hoping for a bit of spark in demand, but right now the market seems to be stuck in holding pattern.
Okay, so I have another question for you, Sandesh. With the recent US elections, Trump has once again emerged as a key figure, and his promises of economic reforms, particularly around oil, have raised questions about global impact. So, Sandesh, do you think an oil driven version of Trump economics, or should I say Trumponomics, could thrive on the global stage, considering the potential volatility it might bring to energy markets and international relations?
Yeah, that's actually a good question. But Shruti, this topic could actually take up an entire podcast, and as the explanation is quite extensive. But if it's all right with you, I will provide a brief overview for our audience, if that is okay with you.
That's perfectly fine, Sandesh. We can always deep dive into this in another episode. So, please go ahead and give us a brief.
So let's have a look at this, Trump got elected last week. Okay, so in during Trump's first term, his approach to energy was very much about bolstering U.S. oil and gas production, and it was specifically shale, which is a unconventional source of crude oil. So his administration pushed hard on domestic oil drilling, and we saw this drive towards what he called as energy dominance. So policies were aimed at reducing red tape and encouraging the oil and gas sector, especially with respect to shale production, which led to a remarkable surge. The US ended up becoming one of the largest producer globally, and they are still largest producer and even the largest exporter also. A shift that allowed the country, that means US, to export more and rely less on imports. So they have reduced their reliance on imports because of this massive production. And it was a defining moment for the US in terms of positioning itself in the global energy market. But one of the most powerful moves of Trump adds his stance on Iran, and which is a kind of a important thing when we talk about the energy aspect of U.S. election. So when Trump's administration imposed some of the strictest sanctions that we have seen, and that effectively cutting off Iran's ability to export oil. So Iran, he mentioned in his speech that Iran went bankrupt, but Iranians are supposed to find their ways because they know how to move away with the sanctions and their repercussions. So these sanctions that he posted had a profound impact because Iran is one of the largest oil producers in the Middle East, and taking that much oil off the market may tighten global supplies. So countries that used to rely on Iranian crude like China and India, well, India is not procuring any crude oil after 2018 to till date, but China is still procuring the same. So when we say India and China, they had to pivot quickly and source their oil elsewhere because, of course, Iranian oil will not be available. So this action pushed up a global prices and disrupted the usual supply lines, and it may creating a ripple effect across oil producing regions and putting a lot of power in the hands of OPEC and its allies who stepped in to fill that supply gap. So having said that, the global landscape has definitely shifted for right now. For one, tensions in the Middle East are even higher now, and that's bound to complicate things. Okay, so you have to understand, if when Trump has its previous term, we don't have any war ongoing, but now that is not the case. We have two wars on the horizon. And while Trump's previous strategy relied on aggressive sanctions and a strong push for US energy independence, this time he would be coming into a market already impacted by Middle Eastern instability. So we are also seeing increased European dependence on US LNG, which is another factor he would like to want to leverage. So exporting more LNG to Europe could give the US more control over the market, but it could also put upward pressure on the global LNG prices. And if demand for the US LNG continues to grow, we might see a situation where both oil and LNG markets feel the effect of US led policies. So when we say about OPEC, now it's a OPEC plus since 2016, and the OPEC plus would undoubtedly be central to any shift caused by a new Trump presidency. We have already seen OPEC plus play a huge role in the stabilizing global oil prices through production cuts and other significant strategies they implement to control the prices. But in the event of resurgence in the US shale production, OPEC Plus stance is more important, and in that event, OPEC Plus would likely have to adjust its strategies, and it should be even further to maintain a right balance. Recently, we saw OPEC Plus delay in the reintroduction of production cuts, taking a cautious approach as they monitor the market. If Trump's policies push more US oil into the global market, OPEC Plus would likely have to respond with extended cuts or I can say that even new measures to prevent an oversupply and keep prices steady. So, however, this Trump election and Trump's winning and Trump's policy may have significant impact, but for the oil importers, it would be a kind of a relief because we expected that prices should be going down.
Thanks, Sandesh. That was an interesting take. Moving on, now let's go through the clean petroleum products or CPP sector now. We have Trisha with us. So, Trisha, can you give us an overview of last week's CPP market?
Sure, thanks, Shruti. Well, last week, tanker market was muted in both the basins. So, if I have to say about LR tanker segment, that is LR1 and LR2 tankers, it usually covers routes between Middle East, Gulf, and East Asia. So that saw freight rates drop quite a bit. Now, tonnage supply was ample, and that created downward pressures on prices, and that's really eating into earnings. For the LR ones, demand remains subdued to balance out the tonnage, so rates have been soft. Plus, a lot of owners were choosing to take on shorter voyages last week, holding off on like longer routes and hoping things picked up soon. So, and it was a similar story with the LR2. So, there was a drop in what they were earning per trip, partly because there was less cargo volume coming out of some of the Asian ports this month. Even the MR segment market was feeling the squeeze for sure, and as rates on benchmark routes like Sika to Japan, they took a bit of a dip compared with like week on week basis, and earnings were down across the board. There was a brief boost in the Atlantic market on some MR routes, but it didn't last long, and things had settled back down under a bit of a pressure. So it wasn't just one thing that caused the market to behave the way it did last week. It was actually a mix of factors. Like first, we saw it weaker refinery margins, less demands from big importers like China, and a lot of uncertainty in the global economy right now. Plus, bigger vessels like VLCCs and Suezmax are now being used more in the clean product market. For example, last year there were 30, and this year there were more than 50 so far. So they are adding competition and making things tougher for the regular clean product tankers. So it's really these combined factors like low demand, oversupply of tonnage, and some seasonal shifts that led to the softer market conditions we saw last week.
Thanks, Trisha. That was indeed a detailed overview of the CPP market for the last week. Now, let's move on to gas markets. Today, we also have Akhilesh, who is handling LPG broking at Saigal Seatrade. Welcome to the podcast, Akhilesh. I'd love to hear your insights on the LPG tanker market. Could you share your thoughts on the market dynamics from last week?
Hi, Shruti. Thanks a lot, first of all, for inviting me to your podcast. And now, looking at the last week's latest assessments for LPG routes, we have seen more notable shifts. Like there were shifts, for instance, on the Middle East Gulf to Japan route, that is our BLPG1 route, rates have dropped by 6.07 points to $47.67 per metric ton, while the US to continent route, that is also known as the BLPG2 route, have also shown slightly softened down to $55.25 per metric ton. For the US Gulf to Japan route, it has held steady at around $98.83 per metric ton with minimal changes. Rates for VLGC and MGCs for the middle MEG to India route, that is basically 1 is to 2 port discharge taking an assessment, have remained stable with VLGCs at $45 per metric ton and MGCs at $40 per metric ton, showing no weekly changes. Turning to the east of Suez market, activity was pretty much subdued last week. So only two deals were basically reported, fixed from the Arabian Gulf for late November and early December laycan. Rates have dropped from low 50s levels to high $40 per metric ton on Ras Tanura cheaper route. For the Indian side, we can say that market participants have been quite active, fixing a record number of VLGCs recently. Owners were hoping for a pickup in freight to the Far East towards the end of the November, as some early December requirements are expected. But with plenty of tonnage still available, there are chance rates could see further downward pressure. Meanwhile, in the west of Suez market, things have looked a bit more positive. Activity picked up gradually throughout last week, with rates firming up to around high $90 per metric ton on for the Houston Chiba route, that is our BLPG3 route via Panama, to which has increased to $100, low dollar hundreds per metric ton for mid-December shipments. We also saw December cargoes conclude in the mid to high $90, although a few owners are holding off on mid-December dates, aiming to avoid extra waiting time. Overall, there is a cautious optimism for what's ahead in this agreement.
Okay. Thanks, Akhilesh, for the update on the LPG sector. Now let's move on to the LNG sector. Trisha, I like to ask you again to give us a brief about last week's LNG fundamentals.
Yes, sure. So last week was pretty quiet overall in the LNG spot charter market. Demand stayed low and we didn't see much new cargo. Rates they had like recently dropped pretty sharply, but by the end of the week they had started to stabilize a bit. While in the Atlantic, we saw some discussions around December and early January charters picking up again in like low $20,000 per day. That's actually a slight recovery from the high teens we'd seen on the recent routes in the Atlantic. But over in the east of Suez, it was a completely different story. There were lots of available tonnage. So rates obviously stayed lower than what we saw in the Atlantic. Towards the end of the week, a short term need did pop up for the early January delivery in the Middle East, which added a little activity to the market. But overall, spot rates held steady around $16,000 per day for the TFDs, while two-stroke vessels were at about $25,000 for a round trip. Now, on the time charter side, there wasn't much new short term activity, just a few two stroke vessels reportedly on subs for 12 to 15-month terms. There were some interest in the contracts up to a year long, with deliveries like they were set between December and quarter one, but nothing too significant. The long terms, like the longer term side, those they saw a bit of more movement as compared to the short term side. A new built 174,000 cubic meters two stroke vessel was booked for a 15-year charter with delivery from a Korean yard to a Japanese utility in 2027. So there were also a couple 15-year deals lined up delivering in 2026 to another Japanese utilities. So we are expecting more long-term tenders for deliveries beyond 2026 to come into the market by the early next year. So things could get interesting in quarter one.
Alright, Trisha, thanks for the update. Now I'd like to move ahead with the chemical and veg oil market. Now, this segment has shown some mixed movements recently, with rates softening on a few routes while others hold steady. So, let's break down what's driving these shifts in demand and vessel availability. Now, in early November, the chemical tanker market presented a mixed landscape. For example, rates for 10,000 metric ton parcels from Al Jabal to Mumbai saw a $2 per metric ton dip, now at $39 per metric ton, reflecting ample vessel availability and lower cargo flow, especially as Arabian Gulf activity was muted. The, the Arabian Gulf to Ulsan route also dropped with a 15,000 metric ton parcels declining by approximately 3%, moving from $60 to $58 per metric ton due to an oversupply of tonnage and a lull in the trans-Pacific demand. Contrastingly, some longer haul trades were firm. Routes from the Arabian Gulf to Rotterdam and the Mediterranean stayed strong for 15,000 metric ton parcels, holding steady at $138 and $163 per metric ton, thanks to robust European demand and balanced regional dynamics. Whereas transatlantic lanes saw further rate drops, with 2,000 metric ton parcels into the US Gulf falling by $8 per metric ton and larger 5,000 metric ton parcels seeing a $5 per metric ton weekly decline, driven by softness in the regional CPP market. From India, rates were competitive. 3 KT shipments to East China traded at $77 to $79 per metric ton, and 10 KT flows to Southeast Asia priced around $48 to $50 per metric ton. Long haul routes such as India to East Asia and Korea to US Gulf commanded premiums as demand and distance kept these freight levels high. Now, moving on to the veg oil segment, India's palm oil imports saw a surge, climbing 59% in October to a 3 month high of 840,000 metric tons as refiners restocked for the festive season. So, this uptick followed a period of low imports with attractive August prices prompting bulk buying. As refiners aggressively restock, palm oil supplies from the major producers like Indonesia and Malaysia could tighten, possibly supporting global prices. The festive period driving higher demand for sweets and fried foods has sharply boosted edible oil demand, which led to significant restocking. Meanwhile, soy oil imports fell by 10% to 344,000 metric tons, while sunflower oil imports rose by 57% to 240,000 metric tons, affected by delayed September shipments arriving in October. Altogether, India's edible oil imports climbed by 34% in October, reaching 1.42 million tons.
Thanks, Shruti, for the chemical update. Now, let's move on to the period fixtures. So, several period fixtures were concluded last week. The notable one was in the crude segment. A VLCC named Samail was chartered by Sinochem for a 12 plus 6 month contract at $47 per day. Thanks, Shruti, for the chemical update. Now let's move on to the period fixtures. Several period fixtures were concluded last week. The notable one was in the crude segment. A VLCC named Samail was chartered by Sinochem for a 12 plus 6 month contract at $47,000 per day. In the CPP segment, an MR vessel Doric Beast was fixed by ST Shipping for a 3 year term at $23,000 per day, while Oman Shipping secured the venture third for a 48-month term at the same rate. Now, having said that, let's walk through the tanker asset market. Let me brief about the VLCC and the Suezmax vessels. So, for a VLCC, a new build would cost you around $130 million, while at resale, it would be around $18 million premium at $148 million. And a 5 year old VLCC, the prices would be around $115 million, while 10 years would be around $84 million at 15 years. So it's around $58 million. Now, finally, if you're scrapping it, you'd get about $19.8 million for it. Moving on to the Swiss Max ships, building a new one cost $91 million, and at resales it would be 99. Now at 5 year olds it would be valued at $82 million, and 10 years would be around 67, and 15 years would be $50 million. So the scrap price for Suez Max, it would be $10.6 million. So this was about the tanker asset market for VLCC and Suez Max. Now, Sandesh, could you give us a global asset and shipbuilding market overview for last week?
So when we go through the LNG new building and second-hand market, talking about second-hand LNG market, there's been a very little movement as well, with just a large steam turbine tanker listed for a sale, but it has no major takers, and that's why no major sales to report as of now. The tanker market was in the similar holding pattern. While asset prices are at their highest level since 2008, the freight earnings have been underwhelming, and the 2024 quarter 4 hasn't picked up as expected. And in the tanker second-hand prices, they have slightly declined since their September peak, but they are still above pre-2024 levels. And that shows that even though sales are down by volume, the dollar value, that is the value of getting vessels S&P, has only dropped about 17% year over year. It's a strange dynamic right now, but where prices remain strong and transactions are limited, and everyone essentially waiting for clear signals on how the market will move it. So to summarize this, the last week's market was bit subdued, but overall since 2022 we have seen a significant market development. So that's it from my side, Trisha. Thank you.
Thanks, Sandesh. That was indeed insightful. So, with that, it wraps up our deep dive into the tanker market. We have covered everything from freight rates and spot assessments in the crude, CPP, LPG, LNG, and chemical sectors to period fixtures, asset prices, and the impact of bunker costs and economic trends. Thank you all for tuning in to Tanker Market. If you enjoyed this, please share it with your network, subscribe, and stay tuned with us on social media for more insights into the maritime industry. I'm Shruti, and until next time, navigate safely and stay informed.
Thank you.